Daniel White, at M&G you manage the North American Value Fund. The stock market in the United States has been strong for 5 or 6 consecutive years. Can it last?
I think that's a great question. I think there's been kind of 2 drivers to the market strength in the US. One has been the underlying economy in the US has been a lot stronger than what you've seen in Europe and the rest of the world, and that's translated into share price performance. The other factor has been the interest rate environment. Interest rates have been very low and stayed lower for longer, and that has led to increased valuations in the US stock market. In terms of whether the market strength can last, I think as interest rates begin to rise, you may see a pullback in some of the more expensive shares within the US market.
But you invest in shares that have low valuations. What are the most interesting shares or interesting companies in North America at the moment?
I think there's a couple of interesting companies. First would be a company like Microsoft, which we invest in. Microsoft's share price had underperformed and gotten down to a very low valuation because people were worried about the slowdown in the PC cycle and the impact of tablets like iPads on their very profitable office business. Since then, we've had new management come in to reinvigorate the company, cut costs, and also move Office to more of a subscription model, so an annuity type business that should have a higher valuation. Another company would be a company called Chevron, which is a big oil and gas company. They're going through a huge capital investment program right now, but which means the valuation is depressed in the near term, but in the longer term we should see a doubling of free cash flow as that capital investment comes to an end.
There is talk of a possible bubble. Do you think that is true or justified, or do you think it's complete nonsense?
I think certainly if you look at the valuations in parts of the US market right now, they do look very elevated, and as I said earlier, that's been driven by the low interest rate environment that we've had in the US over the last few years. Parts of the market where I would be concerned about valuations would be biotechnology companies, but also some of the smaller software companies.
Private investors, though, shy away from shares. Why is that so?
I think many private investors have been burnt or were burnt by the period in 2007 and 2008, where many private investors suffered a large impairment of capital, and I think that kind of memory is still fresh in many private investors' minds, so they've been reluctant to invest in the equity markets and instead been sort of favouring bonds. Now, those bonds have been perceived as being less risky assets and have performed very strongly given the interest rate environment we've been. But I would urge private investors to think about how safe those bonds may be in a rising interest rate environment. You could see those bonds start to underperform quite dramatically, and it may be better to start thinking about switching into equities instead.